The most successful real estate investors don't just know when to buy, they know when to sell. I'm Zoheb Hamirani, founder of Original Bull and Bear Properties, and today we're breaking down the 4 exit timelines for your property in Dubai. Your optimal exit strategy depends entirely on your investment goals and current situation. By the end of this video, you'll understand the pros and cons of each of the 4 exit points I'll be discussing and the situations when it makes sense to consider each one. Let's dive in. Let's start with pre-handover sales. This is when you sell before the property is completed and transferred to you. First, you'll need a no objection certificate, which is the NOC from the developer, which typically requires you to have paid 40 to 50% of the purchase price, depending on the terms set out by the developer. Important note: if your next installment is due within a month, you'll need to pay that too before the developer will issue you an NOC, so factor that into your expected returns. The main benefit for those who choose to sell pre-handover is that they can capitalize on market momentum without waiting years for completion. Many investors have made substantial profits by selling units in high demanded projects before they're even built. The downside is that you're limiting your buyer pool to cash buyers only, as Dubai's real estate regulations only allows you to mortgage a completed property. Another disadvantage is that you will be competing with the developer who's likely still selling units in the same building. Consider this option if you've already seen significant appreciation, you need capital for another opportunity, or you spotted warning signs about the project or developer. The second option is a handover, when construction is complete and you've received your property. The major advantage here is that you're now open to mortgage buyers, which widens your buyer pool significantly. You're also selling a tangible product that buyers can see, touch and feel, which is much easier to sell than a floor plan. The challenge of this exit point is that everyone else is also selling, creating intense competition. Many investors choose to sell at this point, creating a larger supply of identical units. On another note, your ROI at this stage depends heavily on market timing and how the finished product compares to what was promised. Some developments exceed expectations while others disappoint. Consider this exit if the finished property has hit its peak value, the community isn't developing as promised, or you need to free up capital quickly. The third exit window comes after you've rented the property for about a year. By now, you've established rental yield data and have concrete numbers to show potential buyers. This makes your property more attractive to income-focused investors who want proven returns, not just promises. Your ROI calculation now includes both capital appreciation and rental income, often resulting in a more attractive total return. Having a year in with a tenant has also informed you about specific issues that your unit may have. All these will help you take full advantage of the defect liability period with the developer. You can get the developer to rectify any problems your tenant has reported, saving you on costs on getting the property ready to sell. However, there's an important legal consideration with this exit window. If your property is currently tenanted and you want to sell to an end user, whether they plan to live in it or to rent out to someone else, you must provide the current tenant with a 12-month eviction notice. This can delay your exit timeline significantly. Consider this exit if you've hit your target ROI, rental yields are starting to decline, or you've identified better investment opportunities elsewhere. The final exit window we're discussing today is after 5 years or more of ownership. At this point, you'd be selling in a mature, established community with predictable rental rates and clear market positioning. Your property has a proven track record, making it easier to justify your asking price. However, the 5-year mark often coincides with when property ROI curves begin to flatten or decline. Your unit is competing with newer developments with modern features and finishes. Your property likely needs renovation to remain competitive, adding to your costs. This is also when persistent maintenance issues typically start arising, potentially eroding your rental yields. Consider this exit if new competing developments are launching nearby, your maintenance costs are rising, or significant refurbishments would be required to maintain rental rates. To summarize, the perfect exit isn't just about timing the market perfectly. It's more about aligning your exit with your financial goals and next investment opportunity. If you're focused on quick capital gains with minimal holding costs, pre-handover or at handover might be ideal. If you value stable income with moderate appreciation, the 1-year mark could be your sweet spot. And if you're playing the long-term game for maximum total returns, exiting after at least 5 years could work best. But be prepared to reinvest in upgrades to stay competitive. If you found this breakdown helpful, Hit the subscribe button for more real estate investments insights and drop a comment below with your experience selling investment properties. I'd love to hear your perspective. If you have any questions, email me at zoheb@obnbproperties.com. I'd be happy to discuss. Thanks for watching and see you in the next piece.